Greetings! Welcome to our e-learning module on Financial Control Basics, Building a Strong Foundation for Success. In this session, we will delve into the importance of internal controls for nonprofits and how to document the right ones for your organization's needs. This training is one of 6 modules in a series developed in relation to the PACE Self-Assessment Questionnaire. Each module is designed to enhance your understanding of fiscal management and its importance in nonprofit organizations. Be sure to explore these resources to further your knowledge. Internal controls are essential for ensuring compliance with laws and regulations, preventing asset theft, and minimizing fraud by employees. For nonprofit organizations, internal controls are particularly vital as they help uphold transparency and accountability, essential for maintaining a positive reputation with stakeholders. While internal controls may already be in place within your organization, it is imperative that they are documented in writing and accompanied by comprehensive staff training. While this presentation focuses on fiscal internal controls, it is crucial to implement controls across all functions and departments. Today we will delve into 5 key components of internal controls: control environment, risk assessment, monitoring, communication, and control activities. These components are essential for establishing robust internal control systems within organizations. The control environment established by management and the board of directors emphasizes integrity and sets the tone for commitment to uncovering improprieties, including fraud. It encompasses the culture of compliance within an organization, reflecting how both executives and employees embrace internal controls. A strong control environment is fostered when the organization prioritizes internal controls as demonstrated by the board and management. This culture includes integrity, ethical values, competence, accountability, a management philosophy, assignment of authority and responsibility, and leadership vision. Regular risk assessments are vital for identifying potential risks or losses. Based on these assessments, additional control measures may be implemented to effectively mitigate risk. An organization must consistently assess and identify the potential for risk or loss. Based on the findings of such assessments, increased focus and levels of control might be implemented to contain risk or monitor related areas closely. Accounting teams should maintain an always-on approach to risk assessment, as new risks can arise unexpectedly. They should then provide reports to the board to bring any new risks to light. Conducting an external audit is also considered a best practice for objective third-party review. Continuous monitoring of internal controls is vital to maintain their effectiveness. This may involve updating systems, increasing staffing, or providing additional employee trainings as needed. An organization must regularly monitor its internal control system to ensure ongoing viability. This monitoring should occur regularly to identify any deviations or weaknesses in the control environment. Monitoring is one of the key components of internal controls, as it allows teams to identify failures and make necessary improvements. Without monitoring, vulnerabilities may go unnoticed, potentially escalating minor issues into major breaches. Clear communication and reliable information are essential for effective internal controls. Employees must comprehend their roles and responsibilities and adhere to established procedures. Transparency is key. Communicating any lapses in internal controls to management allows for quick risk mitigation. Breaking down silos and keeping everyone informed fosters a culture of collaboration and shared understanding. This practice is crucial at all organizational levels and across departments for maintaining effective controls. Shared agreements, centralized information sources, and regular review of practices and procedures are essential. The ability to openly discuss successes and challenges, identify gaps, and collaborate on solutions enhances control effectiveness. Control activities involve implementing and verifying proper controls through accounting systems and automation. This includes regular testing and inventory audits to ensure controls are functioning correctly. There are 3 main types of control activities: preventive controls, detective controls, and corrective controls. Preventive controls aim to prevent fraud initially by distributing responsibilities and implementing physical security measures. Examples of preventive controls are separation of duties, pre-approval of actions and transactions, access controls, or physical controls over assets. Detective controls are used to identify fraud despite preventive measures through reconciliations, reporting, and audits. Corrective controls are implemented post-fraud to rectify issues and prevent recurrence through disciplinary actions, software updates, or new policies. Separation of duties is a vital internal control in ensuring accountability and minimizing errors in accounting. This principle dictates that no single individual should handle all functions within an accounting cycle, reducing the risk of errors or intentional concealment. Having multiple individuals involved provides checks and balances, enhancing accuracy and transparency. When reviewing the 8 steps of the accounting cycle, it's essential to avoid assigning one person sole responsibility for each step. These steps include identifying transactions, recording journal entries, posting ledger entries, preparing the unadjusted trial balance, making adjusted entries, creating the adjusted trial balance, generating financial statements, and closing the books. Distributing these tasks amongst multiple individuals ensures accuracy and accountability throughout the accounting process. The Oregon Department of Justice Charitable Activities section recommends 14 financial controls for small nonprofits. Separation of financial duties, reconciling and examining bank statements monthly, adopting cash handling procedures, documenting income from non-cash sources, controlling the use of credit and debit cards, controlling the disbursement process, managing expense reimbursements, implementing timesheets and proper payroll controls, utilizing budgets effectively, employing general ledger accounting and generating regular financial reports, ensuring agreements are in writing, appointing a grants manager, adopting a conflict of interest policy, and implementing a data backup plan. These controls have organization-wide implications, and documenting them while providing comprehensive staff training enhances compliance. Organizations document their internal controls in various types of documents, beginning with the organization's bylaws that outline the roles and responsibilities of board members. While each organization may approach documentation differently, all should include controls, policies, and procedures covering areas such as human resources, finance, administration, contracts and grants management, and incident response. Well-documented internal controls are vital, but they do have limitations. They can only provide reasonable assurance regarding the accuracy of financial information and are constrained by human judgment and character. Therefore, it's essential to prioritize values such as integrity and personal trustworthiness when selecting individuals to handle money or ensure compliance. Seek out these qualities in your hires, as they will embody the values that reflect your organization's culture the best. Establishing a commitment to integrity and uncovering improprieties, including fraud, is fundamental for maintaining trust and credibility. At the core of an effective control system lies a culture that prioritizes ethics and strives to eliminate fraud, dishonesty, and corruption. Without this foundation, controls merely exist on paper. Effective control systems originate from the leadership of an organization. Merely stating values in official documents isn't enough. Leaders must exemplify ethical behavior, demonstrate integrity, and take action against violations of these values. When employees witness leaders disregarding internal controls and policies, it not only undermines their importance, but also signals that the organization may be susceptible to fraud. While internal control activities vary across organizations, management typically selects controls that enhance accountability, promote effective management practices, ensure the achievement of intended outcomes, deliver accurate and timely information and reporting, ensure compliance with laws and regulations, and support the needs of external auditors. Internal financial controls are crucial for maintaining the integrity and accountability of an organization's financial processes. They commonly safeguard against theft, embezzlement, and other forms of financial misuse, while also ensuring compliance with laws and regulations. Thank you all for viewing this e-learning module. Have a wonderful day.